I'm delighted to host this meeting today on the IMF's Article 4 report on China. I find IMF Article 4 reports to be invaluable when visiting a country for the first time and you need a crash course on the country's economy. This Article 4 report is obviously of enormous importance given the centrality of China to the world economy and the numerous policy issues that China and the rest of the world confront about the Chinese economy and its interaction with the rest of the world. We are delighted to have Jeff Gottlieb, who will present the Article 4 report. I was brought in at the last minute. Fred Bergston is supposed to be hosting this, but Fred's under the weather and sends his regrets. So I don't know how we ended up with James Daniel, who's also from the International Monetary Fund, being a discussant. But however we ended up with this situation, we're very pleased to have you. And Mr. Daniel will be followed by the Institute's Nick Lardy, who I'm sure you all know. So without any further ado, I will turn it over to Jeff Gottlieb for the presentation of the report.
Okay, thanks for having us. It's nice to have an opportunity to present this to so many familiar faces. So yeah, the challenge, I agree that Article 4 reports are always very helpful for your first visit to a country. The trick is making sure that they're useful in your 20th visit to the country. I'll talk about three different sections. One is the recent developments, the context of the environment in which this Article 4 took place, which is quite different than previous years. Then I'll go into the revision to our outlook, which was the biggest headline that the media picked up on this year out of the Article 4. And then I'll briefly talk about the policy issues and the policy recommendations that we're making without taking too much time to make sure there's time for questions. So the environment in which this Article 4 took place was the best out of the last 4 years in which I've been visiting China. This is always significant. This was significant for two reasons. One is if you've been warning about vulnerabilities for the last several years and the environment turns extremely good, you ask yourself whether you are wrong about your assessment of the risks in China. The second reason it's important is because it changes the degree of concern of the authorities about how urgent the risks can be, or it can modulate the focus and the sense of urgency. So those were two things that we had to focus on a lot. First, I'll start with the GDP. Real GDP statistics in China obviously they don't move as much as you would be accustomed to in other countries. But the significance of the current environment is that after about 9 quarters of deceleration, we had stability and a marginal acceleration. This acceleration was much bigger in nominal GDP terms because after several years of deflation in PPI, we saw a sharp acceleration in prices, which allowed for nominal GDP to look considerably better, which flattered the debt ratios that we care about, and it also made debt service marginally easier. This story is a key part in assessing how you view the risks in China. The authorities say that this is because they've started to address capacity issues. This reflects the reform effort. The previous downturn was purely it was partly cyclical and partly structural, related to these reform issues that they've now addressed, and that this is going to be the new normal going forward. The alternate view would be that this reflected stimulus and a brief uptick, and that we're going to be resuming facing those problems again. But the GDP environment got considerably better. The next thing that was significantly improved is the capital flow and the balance of payments situation. You can tell by the crowds that we speak to that the crowds are always biggest when these numbers look worst. These have improved for 3 reasons. One is the capital controls, which they put in place. The key thing here is that it's not so much that they introduced new de jure controls, but they started enforcing the controls that were already on their books. They started much more lengthy verification process. The second thing, and probably the most important, is that the growth outlook looked considerably better. So then the thought that the authorities needed to generate a large depreciation in order to support growth had started to fade into the background. You can also tell stories about interest rates started to be a little bit higher. What happened with the dollar is significant for people's expectations about the currency. But growth and capital controls helped a considerable amount. And this is obviously the related point about the exchange rate. We think about the exchange rate has had broadly 3 phases over the last few years. Until August 2015, there was roughly a peg against the dollar. Then, after that peg had resulted in a very large real effective appreciation because of the link to the dollar during the superdollar's rise, the authorities changed, or in that environment, the authorities changed their exchange rate regime in August of 2015. They generated a sharp depreciation over 2 days, but then managed the currency down between then and late 2016, in which they unwound most of the real appreciation that it experienced before. And then in the third phase, there's been roughly a peg against the basket. Again, you can do various studies that show that it's not perfect and that at different times it is the peg is or the managing against this basket is stronger than others. But the key point is that they managed stability against the basket during the dollar strengthening, and then most recently it's been roughly stable during the dollar weakness. This is very important to the narrative people tell about China. Some say the depreciation was driven entirely by the fact that there's vulnerabilities in China that have not been addressed, and thus people were voting with their feet. The other narrative is that the authorities, with a closed capital account and very large reserves, have some ability to choose the level of exchange rate that makes sense over the near to medium term. And so as a result, when they generated this depreciation, they changed expectations and everybody ran to get ahead of it. And now that you've stabilized the currency, those expectations have calmed down. There's likely some truth to both stories. On the policy front, the biggest positive story going into this Article 4 was that the financial regulators had started tightening on intra-financial sector and claims on the financial sector, claims on the non-financial sector. You saw, again, like the capital controls, not so much new regulations, but you saw tougher enforcement of existing regulations by all the major regulators. One of the manifestations of that was a higher price of credit. So you saw the market interest rates rise in many different product classes. So it's not so much that, policy rates did not increase. The monetary policy rate increased 20 basis points, but market rates increased a lot. 2 major impacts of this. First, the intra-financial sector flows stopped growing. Now, again, so there's not many economies where we find this to be as large of an issue as in China. The US is the obvious other example where it's a very large issue. So intra-financial sector flows on balance sheet and off balance sheet had grown aggressively, and in the context of this recent increase in interest rates have stopped growing, which is encouraging that that's been able to happen without a run on products in the intra-financial sector. The second big consequence is that the claims on the real economy, so the blue line is credit growth, the claims on the real economy have also started to slow. So what you have here is credit growth to the real economy, and you have nominal GDP growth. To use the metaphor of fiscal policy, in order to have sustainability of this private debt, what we need to have happen is that private credit growth, or credit growth to the real economy, starts growing as fast as nominal GDP and eventually slower than nominal GDP. The fact that it's growing faster than nominal GDP means that the ratio is obviously not stabilizing. The challenge is figuring out how quickly to have this deceleration. If you look at the very rapid deceleration in credit growth between 2011 and 2015, this was an environment in which concerns about the real economy were accelerating quite quickly, and you got quite large concerns in global commodity markets and in other asset classes. So the trick will be finding ways to slow this credit growth in a way that is not resulting in a destabilizing or disorderly adjustment to the real economy, which would be counterproductive. So now let me say a couple words about the outlook. We revised up 2017 marginally based on the strength of the first quarter GDP growth, but more significantly, we revised up 2016 to 18 by almost a half percentage point per year. In some ways, this was at odds with other things that we've been saying, which have shown greater concern about the Chinese economy. But the way to make sense of those two is that we changed the way we think about the forecast in China. Historically, what we did is we incorporated in our baseline the idea of an active scenario, that we thought the authorities were going to change their own policies to generate a slower economy. We probably also were using some idea of signaling what we thought was a safer growth for the economy. But this approach that we took now reflects what we think is the most likely scenario, which is that the authorities will stick to their existing targets, which is to double 2010 real GDP by 2020. And this is the path that does that. We think that, in short, they have the willingness to reach those targets, and we also think that they have the capacity, given buffers, to basically adjust policy as needed to reach that target. And the way we manifested this in the macro framework is to, instead of having the assumption of sustained consolidation in fiscal policy, we halted the consolidation, basically removed all consolidation and left fiscal policy at around 12 to 13% deficits. The result is that you see debt of the non-financial sector, public and private, rising over the medium term. There's lots of uncertainty around this forecast, but this is the result of the new macro framework. So I'll just say a couple words about the policy environment, and then I will stop to ensure that we have adequate time. So in most places that we work, the three biggest pieces of our advice are fiscal policy, monetary policy, and exchange rate. So I'll briefly say a word about those, but there's no country I've worked where those have been less the focus of what you think is necessary to ensure external and internal balance. These are big issues, but the structural issue is the much bigger issue in China. But I'll say a word about the fiscal, about these three issues. The first is that the deficits are very large and growing, but even more difficult is the fact that we don't have agreement with the authorities about how to think about it. We include a very large stock of the SOE spending that by GFS standards, based on the relationship between revenues and expenditures, would be included in the general government, not just the broader public sector. We think it's the better representation both of liabilities of the government and of the impulse to the real economy. And by that metric, you see the debt stock growing aggressively. The authorities would look at the solid red line. We have been advocating half percentage point in consolidation here per year, again, trying to balance the need for slowing debt growth with wanting to ensure that the impulse to the economy does not undermine the denominator. The second thing is on monetary policy. We agree that we think that the current stance of monetary policy is accommodative, but we also think that monetary policy should be primarily governed by what's happening with inflation. And on inflation, we're really not seeing increased evidence of upward pressure. We would rather, to the degree that credit concerns are leading to financial stability concerns, we would rather those addressed by macroprudential and other supervisory measures. That said, we are starting to see core inflation tick up, and there's an argument for leaning against the wind. So for now, our advice has been that this should be data dependent, but that generating a sharp increase in the policy rate to slow credit growth has not been what we've recommended. And finally is the exchange rate issue in terms of the core macro issues. There's a lot of pressure within the fund about how to think about this exchange rate. And with an economy like China, there's a strong desire to have a highly flexible exchange rate. And when you have capital outflows like what happened most recently, the pressure for that increases even greater. But while this is a crude metric, just looking at the export market share, it is hard to see the exchange rate as being the first order problem facing the Chinese economy. As I'll get to in a second, we see the structural issues as being much bigger. So if you don't see a sharp fall in competitiveness as defined by the current account, and you believe the capital account outflows are driven by some unanchored expectations, it feels like an overvalued exchange rate is not your first problem. But this is a much more complicated issue that maybe we can talk about in the question and answer. So that leaves these structural issues, which I won't go into in detail. Maybe I'll stop here. But these are the issues that we focused on the bulk of our mission on. Well, maybe I'll say a quick word about these. The first issue is that we see the savings rate as being too high and the consumption rate as being too low. The result is that you either have an external imbalance or a domestic imbalance. The second issue is that we see, no, I'm okay. The second issue is that we have been advocating greater pace of reforms of SOEs because once you adjust for the level of subsidies, you find that the return is much lower relative to that of the private sector. So we've been advocating less resources going to the state-owned enterprises. The next is the overcapacity sector, where we see outsized market share globally and still very low capacity utilization rates across all the major sectors. This is an area that authorities are focusing on a lot, but has been very difficult for us to verify the degree of progress. The fourth is corporate debt. A key challenge here is that we have great suspicion that asset quality is far worse than what the authorities are saying. The problem is the official NPL rates suggest that they are around 1%. So we look at alternative ways of thinking about asset quality. One is if the liquidation value is greater than the current value. Another is if profits are inadequate to cover your interest costs. So we've been looking at different ways of looking at asset quality to argue that the authorities should be more proactive, both at reforming the corporate sector and at recapitalizing the banks. And then finally, it's financial sector fragility. This is the issue related to the intra-financial sector flows, where you see large commercial banks are funding medium and small commercial banks and the non-bank financial institutions. And the recent supervisory effort has slowed the degree of those flows, but they remain quite large. And the challenge being that if you do have a hiccup, it's very difficult to provide adequate liquidity in a targeted way, and the risk is that you flood the system. So I'm going to stop there. That's relatively quick, but those were the key structural issues that we faced and we focused on this year.
Too?
No. Oh, just talking. Should I talk from the table or?
Whichever you're more comfortable.
Yeah, you talk from the table.
Okay.
So maybe discussant is too strong a word, but I would like to give you a bit of the flavor of the conversations that we had in Beijing. One of the great things about working at the IMF is you not only get to write these reports, you also get to discuss them with the authorities. And the authorities don't really have much choice, but at least for us, we at least can have an interaction and understand the other side of the arguments. So let me just try and give you a flavor of some of the more crunchy parts of the discussions that we had in Beijing. So 3 topics: rebalancing, the debt risk, and SOEs. On the rebalancing, the big picture stuff, they're on the same page. Yes, we need more consumption, we need lower savings, we need lower investment, but they see no need to accelerate. They actually see the economy doing quite well on these dimensions, and they don't need to go much faster. And actually, when you probe a bit, they're quite comfortable with the level of investment. They say, we have only 1/5 of the capital stock of the USA, we need a huge amount of investment. What's the need to slow down here? And they're much more sanguine about the quality of the investment. And on savings, they feel it's an asset in a way, that it enables them to achieve their investment goals without having to rely on foreigners. And they see it really as a boom to China, even though they recognize conceptually consumption needs to increase. And they'll also make the point, and they'll look across the table at me, and they say, we also don't want to have the European systems where they have these very expensive social security schemes that end up causing a lot of problems, and they want to avoid that. So that's a bit of their perspective. Rebalancing, yes, but not too fast. On the debt and the risks associated with it, I mean, we hit them for years now with these pictures of big increases and, risks left, right, and center. And they say, look, we agree debt is a problem and we want to deliver, and that's our intention, and we're doing it. But they say your projections are too alarmist. We look at what's happened over the last 5 or 6 years and tend to project it forward. They tend to look at the last 4 or 5 years and say that was an anomaly. That was this period of remarkably low producer prices and weak profitability. And now, when leverage is growing less and profitability is better, this is more the new normal, not what it was in the past. And they say our reforms actually are biting more than you give us credit for. And they'll read out hundreds of things they've done, and it's hard for us to judge, but they say this is having a real impact. And you can see it. You can see it in the prices of steel and coal, and the fact that we've laid off all these workers, and all this restructuring of our companies, and the moving up the value chain. And they'll come up with a lot of examples. And they say it's having effect, and you can see it today. And then they say, even if you're right, we reckon we have more time and more levers to deal with it. In the end, they say, James, it's all in the family. We control the lenders, we control the borrowers, we have many levers that you don't have in other countries, and we think we have the buffers, the low government debt, the high foreign exchange reserves. This is not quite as urgent as you think. And they also say, when we talk about the growth target, it's not a hard target. If we think the growth is risky, we will slow growth down. It's just that we don't think it is as risky as you do. And lastly, on the role of the private sector, and they agree with the need to increase the efficiency in SOEs. They say, yes, we agree with that. We want that, and it's happening. They also do see a bit more of a role for market forces, opening up a few more sectors to the private sector, closing down some of the least well-performing SOEs, especially in sectors that they don't care about. They also deny that SOEs get subsidies, even implicit subsidies, and they also deny that they're less efficient inherently than private enterprises. But this is where probably the biggest difference is. They just have a fundamentally different different view of the role of the government. To them, they have all these objectives for their economy over many, many years, and the SOEs are part of that. They are the lever to implement government policy and achieve the objectives of the nation, the party and the government. They, in old-fashioned Europeanese, want to maintain command of the heights of the economy. They see an active role for SOEs. SOEs are actually getting bigger. They're getting more powerful and more party-controlled. And I thought I might just quote from, not something you often do, but the China Railway Group, a large SOE, just changed its, publicly listed, I think, just changed its articles of association. This is what it has inserted. When the board of directors decides on material issues, it shall first listen to the opinions of the party committee of the company. That's their approach. And that's fundamentally different, and we can talk around that, but that's, I think, a difference which we have to be aware of. So I'll leave it there and turn it over to others.
Well, I agree with what Mark said at the outset. And Article 4 is a good way to get up to speed on a country that you don't know too much about. But I would also supplement that by saying that even if you've been working on a country for a long time like I have, you look forward to these Article 4s because you always learn a great deal. I learn a great deal from these reports every year. And I think particularly in recent years where they have given, shall we say, space to the authorities, where the IMF lays out its views, and then as James has just summarized, at least some components of the Chinese bureaucracy push back and say, well, things aren't as bad as you think, we can carry on for a while longer, and so forth. So you get a very good sense of the thinking of the authorities in various domains, particularly on some of the issues related to SOEs and particularly debt. So I think these are terrific reports and extremely valuable. I think they do also have some influence within China, and I think there are people within China within these bureaucracies who welcome the Article 4s and hope that the IMF staff will push a more reformist line in order to give them some greater credibility in the internal debates. Having said that, I want to make really two main comments, and closely related to what Jeff was saying at the beginning. Certainly, we've seen that various measures of credit growth have slowed substantially in recent quarters, but as was just laid out, the fund decided to assume that China is going for growth, that it will double the GDP by 2020 compared with 2010, and that this at some point will require a substantial reacceleration of credit growth to something like the pace of the last 4 years, and that's what would generate a credit to GDP ratio of something very close to 300% by 2022. I'd just like to sketch out an alternative view. My alternative view is that I think the leadership has now prioritized reducing financial risk. Xi Jinping has given several speeches on financial risk since December of 2016. I don't think he's ever talked about this before. So this is something that has risen in prominence in the thinking at the very top levers of the leadership, and it's also reflected in a number of policies. Certainly the creation of the Financial Stability and Development Commission in the summer reflects the heightened, this is to better coordinate regulation across the various regulatory agencies. The regulators, I think, have been emboldened by Xi Jinping taking up this theme of the need to reduce financial risk. The insurance regulator has curtailed insurance companies' ability to issue short-term products to finance long-term investments. The banking regulator has issued new regulations that reduce the ability of banks to engage in various forms of regulatory arbitrage, notably the classification of a lot of loans as investments against which they don't have to hold much capital. So these reforms are requiring banks to increase capital relative to their assets. And finally, credit growth has slowed quite substantially, and we saw the slides. The growth of total social finance, adjusted for local government bond issuance, has been trending down quite considerably, particularly over the last year. Bank claims on non-bank financial institutions have plateaued. Again, we saw the slide on this. The value of wealth management products outstanding is shrinking. I think this is a result of some of the reforms that have taken place, and a variety of short-term interest rates have risen, roughly 150 basis points in recent quarters. Yeah, the benchmark rate hasn't changed, but the benchmark rate doesn't really matter much anymore. So my view is if growth slows, so many people are saying, and this is a very common view in the financial industry, yes, credit growth has slowed down, but within another quarter or two, growth will slow down and we'll have a reacceleration of credit growth. But they may not, the leadership may not choose to, may choose not to reaccelerate credit growth. They only need to get 6.2% per year in 18, 19, and 20 to achieve the goal of doubling GDP. They've been growing a lot faster than 6.2, so it is certainly plausible that they could achieve an average of 6.2 over the next 3 years with credit growth that is not as high as it was on average in the previous 4 or 5 years. And I think, as James just mentioned, I think there is a willingness to accept slower growth in order to achieve the goal of reducing financial risk. So I'm of the view that we should be watching credit growth very carefully. Is it going to pick back up, or are they going to go on this path of slowing down credit growth? So that's my one kind of main alternative view to what's expressed in the Article 4. The second issue I want to say something about briefly is not really addressed very clearly in the report, and that is the slowing of private investment relative to state investment. If you go back and look at the data historically, up and through 2011, private investment was growing 2.6 times the pace of state investment. From 12 through 15, it was growing only at 1.4 times. And in 2016, the data are still a little bit uncertain, but it looks like the growth of private investment was only about half that of state investment. So there's been a very substantial change in the composition of investment. over this period, and I think it's very closely related to the slowdown of economic growth. Again, we saw the slide, the return on assets of private companies is at least 3 times that of state companies, and if you make some of the adjustments for subsidies and so forth that was mentioned, the gap might be substantially larger. But the report does not really focus on what's the underlying cause. Is this crowding out? Private firms are getting less access to credit, or are there some other explanations? I think this is a very important thing for trying to understand the slowdown in economic growth in recent years, and also trying to look forward to see how rapidly the economy might grow over the medium term. If the state continues to grab a larger and larger share of investment resources, I think growth will come down further. And the hope would be that whatever has caused this slowdown in private investment, that perhaps that might be ameliorated going forward. So one issue I disagree on is whether or not credit growth will resume at the previous pace. The second issue that I think I would have liked to see more discussion about is why there's been such a substantial change in the composition of investment away from the long-term trend of an expanding role for the private sector.
Thank you very much. The Peterson Institute for International Economics has been in existence for about 35 years. I have been affiliated with this institution for most of that period. So I cannot say, I think what I'm about to say is with a high degree of confidence, though not perfect confidence, that today, September 21st, 2017, is the first time in the history of the institution that we've hosted an event with 3 speakers, and all 3 speakers kept to their allotted time. It is a truly stunning achievement, especially Jeff, who managed to cover an incredible amount of material in sort of no time flat. So before we open it up to questions and comments from the audience, I was wondering if Jeff wanted to respond to either of the commentators.
Yeah, just 2 brief comments, and I apologize before. I think I was speaking like an auctioneer, speaking a little bit more measured. On the first, it is possible that there's been a change of heart in China. I can't profess that we have the expertise to know deep what's going on within Xi's mind. I think our responsibility is to say that this is the consequence of currently stated policies and show what that involves. What's been happening in previous years is that we've been showing what we thought should happen, and as a result, we were understating the actual impulse that would be happening to the global economy from China. So we think it's useful to talk about current policies with some humility that we could be wrong, they could change their mind after this party Congress. On the second point about the composition, it's absolutely important. So if you look at state-owned assets, starting in 2001, they were declining until 2008, 2009. And since then, they've risen by 80 percentage points of GDP to a total stock that is several multiples of any other largely state-oriented society. So there's no question that the composition has changed. And this is one of the reasons that we're reluctant to have sharp increases in interest rates, because we're concerned that the state-owned enterprises are the ones that are least elastic to the cost of credit, and so that you would get a further decline in the quality of credit. But fair point. We could have covered that in greater detail. I'll stop there.
Great. You think it's difficult reading Xi's mind. Think how I feel when people ask me what's inside of Kim Jong-un's head. All right, so we will now open it up to discussion. What I would like you to do is raise your hand, indicate who you are, because everybody in the room may not know each other. And since you don't have microphones and we do, and it's a pretty big room with a high ceiling, please try to project. And we'll take a few questions or comments and then give people a chance to respond. Oh, there's a microphone. Great. So who wants to speak? Tell us where it should go. Oh, yes, sir.
Thank you for the great presentation. You know, as always, at least from a market point of view, the question is, those are the risks of a crisis, but what would the triggers be? And generally the answer is domestic banking sector related triggers or external ones. But just to kick it off and starting on the external side, you laid out what the FX regime seems to have shifted to now, which has worked in an environment of 11% dollar depreciation this year. So if and when that environment changes, what do you think their reaction function would be? And if it is indeed what people keep saying, which is, well, they'll tighten capital outflows even more, is there no cost to pay for this continuous tightening of capital outflows? And if there is, what is it and how would it represent itself?
Okay, so the way I think about the exchange rate is that there's kind of a matrix. We have seen a world in which dollar is strengthening and there's not enforcement of capital controls. And now we're seeing a world in which there's enforcement of capital controls, but dollar is weakening. The environment we have not yet seen is one in which dollar is strengthening, and yet the capital control regime is in place and strong. You know, kind of mathematically, you would think you might see outward pressure, but not on the scale of what we saw in 2015, 16. But I think it's not clear. So it is certainly a case where the authorities want to establish some comfort with the exchange rate moving in both directions, such that they can allow for movement without it generating large-scale concern. It's one of the motivations for having strong growth. Because the minute the growth is weakening and you get capital outflow pressures, people will feel that they're generating a competitive devaluation. So I think the key thing is that we haven't seen this environment before. They really scrambled to put in place this capital control regime in a way that they could enforce more effectively. In terms of the risks of that, I think the risks are coming in a variety of ways. I think that right now, capital outflows are being both constrained by the Chinese to prevent what they consider bad outflows. Then they're also being constrained by US and European governments resisting and being more desirous of resisting capital outflows. But I think the core thing is that the expectations became quite unanchored when they moved very quickly without having a capacity to communicate what they were doing and why. So at the margin, what we've been recommending is that you still need to move to a regime of flexibility, but in the short run, it never seems like an ideal time to generate that flexibility. I think in the end, they've been quite successful. They've been able to unwind a very large real effective appreciation in an environment of a still heavily managed currency and been able to maintain some competitiveness. But of course, that's $1 trillion reserves later. So in an ideal world, at some point in the future, this is an inflation targeting regime with a different nominal anchor and an independent central bank that can raise interest rates if there's excessive depreciation on the currency. But that environment seems quite far away.
Joe Gagnon.
Thanks, Joe Gagnon, a senior fellow here at Peterson. Two related questions. I've been thinking, and I think others have talked a lot about how China needs to rebalance away from so much investment to more consumption, and you mentioned that, but then you said well, I was interested to hear the authorities don't seem to share that view. So I guess that may explain why they have been less keen to beef up the social safety net and in healthcare and education, which would help to encourage consumption. I guess my question is, if it does become apparent that investment does need to come down or is forced to come down, one or the other, do you think then they would move quickly in that direction? In other words, is that an open door that we would be pushing on once they change their mind about how strong investment's likely to continue to be? In other words, once they realize investment's going to, if it turns out that investment needs to fall or does fall, or they realize that it's wasted, if it's wasted, they realize they need to reduce it, would they have the flexibility to move quickly and try to do things that would boost consumption? And because I was thinking it would be an easy thing for them to do politically, and yet they haven't done it. And I guess the answer you're telling us is, well, they think they don't need to yet, but would they move fast? And the other related question related to the external balance is the data. We saw a presentation some time ago that the current account may be understated by as much as a % of GDP because a lot of the recorded tourism expenditures are actually capital outflows. And there's a cryptic sentence about that in the external sector report. Did you discuss with the authorities that, and what are they saying?
Sure.
Maybe I can reply on the first one. I spent 20 years of my life at the IMF going to countries to telling governments to spend less and to be more prudent, and it's really kind of weird to go to a country and say, guys, you have space, spend more. It's a strange, invest less. It's a strange situation to be in. But there is a reluctance there and an inherent concern about long-term fiscal sustainability. They really are concerned not to get themselves into the mess that some other countries have got themselves into. And they're very aware of their rapid aging. So there's a general reluctance not to go too fast. And they also point out the growth rates of social spending are really pretty high. And the deficit, as they recognize it, is already 4%. And they keep referring to the SGP, the 3% in Europe. They say, look, already it's a bit tight, debt is already 40. And so they're quite, I was going to say German, quite conservative in their outlook on fiscal policy. And I think the answer is, if they saw growth come down and investment come down, what would they do? I think they would go back to the old playbook. I mean, we saw that in 15. They would probably ramp up investment again, but it may not necessarily be on budget. It may be off budget, but also it could be more the housing market again, or other areas that they could loosen up government control. It would still be, I think, more the old-fashioned response. So I don't think they've got to the stage where we need a tax cut. We're going to cut VAT rate. That's just not their, they don't really think about it. It's more like it will turn the spigot up or down on local government infrastructure spending still.
Yeah, just to echo on that, I think there's a strong view that if you have to stabilize output, it comes via building trains, building high-speed trains rather than cutting checks. On the tourism issue, I think the way I think about it is that tourism is likely overstated by more than the current account is understated. So some of the data challenges manifest themselves in some of what is called a service import can be a good import, and some of what they call a service import is a capital account outflow. So the data challenges of this are real, and I think that's the key point, is that all of the tourism mistakes are not capital outflows. But even that said, using the magnitudes that are discussed, it wouldn't wildly change our policy conclusions about where things on the external balance are. The key point is that they've replaced an external imbalance with a domestic imbalance, and the only way to address one without creating a return to the other is via savings. And that's why we emphasize trying to add on to the structural factors of reducing savings with policy factors.
Yeah, I'd just like to make a couple of points. I think, first of all, it's not quite right to say the authorities are not in favor of rebalancing, and they have very substantially increased social spending as a share of GDP. I think it's doubled since the global financial crisis. You can also see it in, and by the way, it's having an effect on household savings. The household savings rate has been coming down since roughly 2012, although the data comes out with a long lag, so we don't have real-time data. But I think the household savings rate is coming down in part because of the substantial increase in social expenditures. You can also see it in the growth of disposable income. Disposable income growth has been running way ahead of GDP growth, and it's partly because wage growth, the wage share of GDP has been going up, but transfer payments have been rising even more rapidly. So the disposable income increase as a share of GDP is not just wages, not just the wage share growing, but a substantial increase in transfer payments.
Great. Yeroman?
Thank you. So I have one question for James and one. Oh, I'm Jeroen Zettelmeijer from the PIE, sorry. So I have a question for James and one for Jeff. So James, in your intervention, you could be interpreted as saying that conditional on Chinese preferences and the Chinese political system, they're actually managing their economy optimally. But I suspect you don't quite mean it. So I wanted you to give you a chance to clarify. So I would So the thought experiment is, supposing we move James Daniel to Beijing and put him in charge of the party and infuse Chinese social preference in him, would he run it in the same way? I don't think he would quite run it in the same way, particularly because I think that, the commanding heights argument has limits when you don't think that the state enterprises are actually a very robust or an ideal transmission tool, right? Returns are low. Maybe it's not the ideal way of, but you give the answer. And then the other question was on to Jeff. So Nick raised this puzzle or Slater's fact about private investment coming down. I think you only answered about half of his questions. I want to ask the other half. So it seems that it's very important to understand whether private investment dropped as a result of lower expectations of Chinese growth, so essentially a demand argument, or whether it was a crowding out, real returns of investment, most of a supply side argument, financing conditions, because depending on what your analysis is, you're going to get dramatically different expectations on what investment is going to do now, going forward. So if it is a demand argument, you would actually expect private investment to recover the instant they read the Article 4, right? Because now expectations have gone up again. So are you now quite sanguine also about private investment?
So what would I do if I was in charge? To me, having worked on European countries before I came to China, it's all about the debt. This massive increase in bank balance sheets, and pretty much every balance sheet you can see in the economy is just ballooned. And that's a problem. We've learned that. We don't know when. It's like, you're a doctor and someone comes in and they put on £5 and £10 and £15, and you say, this is not good. And they say, well, when will I get my heart attack? I need to plan for it. Well, I don't know, but you just can't keep on this track, and maybe a bit of exercise and eating less might be a good idea. So that's where I'm coming from. I think I would put a much bigger emphasis on reducing the credit intensity of growth. And it's not a private sector problem because they don't borrow. It's an SOE sector problem because they're the ones who are borrowing, and they're being abetted by the state-dominated banking sector. So my approach would be, let's take the worst offenders, take them outside and shoot them. Let them die. We have to get rid of these guys. These zombies that are having, huge amounts of credit intensity, producing no value added, we have to make an example of them, and then you gradually work backwards to the rest of the system so that we can keep growth rates high, we take out the worst offenders in terms of abusing credit, and we get a bit of discipline into the state sector. So maybe it's a little brutal, but that's the overview of what I think the main problem is.
Yeah, this is a fair point. I didn't really address that, and I wish I had a better answer. I think we lean in the direction of it being a supply-side issue, that the model of the economy that has been followed under Xi has been one that has emphasized a strong role from the state, and the banks are happy to provide the credit, willing to allow that to happen, and that's what's driving the assets higher. But they say that, and we're also anecdotally told that private sector enterprises are not starved for credit, so the credit is growing in that context as well, just not as fast, and that this just reflects the outlook of the state at this stage in the cycle. But it's true. I don't have a firm answer on it.
It's a good thing there are no reporters here today, or the headline might be, IMF, execute the fat guys. Roy McFarquhar.
I am Rory McFarquhar from Google. A question for really all three of you. So it is remarkable to see how China has faced down the wave of capital outflows and essentially debunked one of the theories for what would cause this debt bubble to deflate, namely, some sort of externally driven shock. So if it's not going to come from the external side, then how should we think about how much weight these zombies can put on? How should we think about what the limits are to credit expansion, and whether they can even make it to 2020 according to your new forecasts of expansion? Like, what are the limiting factors, or are the Chinese essentially right that this can just trundle on essentially indefinitely because it's all in the family?
Okay, so right. So the way in which we normally, the way I think about, make sense of this in my head is that, okay, assume that capital controls can work extremely well, and so thus you can prevent a run for foreign assets. It's a bit of an assumption, but assume that. The next wave would be still that you could get a run from the banks, and so that you could get a run from more of the dodgy financial institutions, and you could get a run to the mattress. Even then, that would require people having lost faith in the entire financial system. So what's likely to happen in that context is more of a compositional shift. So you run from the shadow and run to the formal system, and thus liabilities as a whole are okay. So that, to say that you're going to get a situation where there's a loss of confidence in the entire financial system seems it seems difficult to get there based on capital ratios and other constraints in the economy of what they control. So as a first pass, it is difficult to do it, but as the gentleman from Goldman was saying, we tend to think that the trigger will be an intra-financial sector hiccup that leads to a run more broadly. I think that the concern would be if investment basically just decelerated extremely quickly, and with the current rate of decline in savings, we basically just see that as quite unlikely. So I'll stop there.
Maybe I'll just add, it doesn't have to be a crisis. Japan, you can have a Japan scenario. So maybe they control all the levers to prevent a crisis. They can stop the money getting out. They can make the banks sound. They can make sure things stay on track. But you cannot ensure that your investment is efficient. That's the real challenge. So if you're increasing your debt stock year in, year out, and the amount of income that it generates is going down, 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 that's an inherent problem that you cannot really fix by all these party controls. And at some stage, you will realize you will not be repaid. And someone will have to pay the price for that. And it could be done in a coordinated way, but still there'll be large losses that need to be allocated in this economy, which will just keep growing over time.
I think the key thing is that nothing of what we're hearing suggests that there's a desire to do a big recognition of weak assets and a move to the balance sheet. Everything points in the direction of wanting to grow out of this problem, both domestically and externally by exporting.
Thank you. Ted Truman here at the Institute. I was interested in the comment about Japan, so it's an interesting way of my thinking about this situation relative to sort of 1989, 90 or something like that, but that's not my question. A small on the current account data question that Joe asked. There really are two aspects of it. Part of it is just analytics, and maybe it's a fair problem of they want to do the accounting right, but it's complicated to do the accounting and so forth and so on. And as he said, we had Anna Wong here who presented her paper, and I'm well aware of the fact that she's talked to you guys. The thing that was most troubling was the fact that when they went back and corrected it, they corrected it on both sides. And for those who still raised, despite the fact that Nick Lardy claims that their statistics are much, much better and almost up to international standards, this does lead to some question about whether that is true. I'm interested in a comment on that. The other thing is on the SOEs and the subsidies, one would think that I'm thinking about poor Andreas Georgiou and the Greek deficit, right? There are standards, international standards for how you calculate these kinds of things, right? And I'm surprised that in some sense there's this standoff in this area. The other side of it is, the second part of the question is, does it make a difference? One has the impression, and I'm probably not right, one has the impression that the outside world thinks that the SOEs are the driving, non-competitive force of the Chinese economy, right? My sense is that's probably not true. They may be the driving force of maintaining aggregate demand inside the economy, but they're not a source of Joe Gagnon's concerned about the imbalances, it seems, the direct imbalances, correct, maybe indirect, but the direct imbalances, right.
Maybe I'll briefly talk about the first one, at least. It's nice to see Ted. Ted was my first boss that I ever had, so at Treasury. On the statistics question, there's two notional concerns. One is if there's something pernicious happening, and the second is if it's leading us to a misleading policy conclusion. And it's true that the change in the timing of the second revision looks like something pernicious is happening. You know, this makes you, and one of the reasons why people might have that thought is because during the period of reserve accumulation, there were lots of ideas on how you could hide further reserve accumulation. So that is always possible. When you meet with the authorities, that is definitely not the impression that you get. You get the feeling that there is a real desire to have the right answer and that there are technical constraints to getting it. But again, I think the more important one is whether or not there is something that we're getting that's very misleading for our policy conclusions. And on that front, I just don't see that we would say things that differently than what we're already telling them, even if you took the worst of Anna's projections or calculations about the tourism. I'll stop there. You want to handle the second one?
Were you asking about the fiscal deficit thing, or this was just the tourism? Okay.
No, but the second question on SOEs?
And why is it I can understand there's a difference in, but presumably there are international standards for calculating this kind of stuff. And then the other question is whether indeed it makes a difference. I mean, I think a lot of the arguments one hears, I stand to be corrected by the trade people, is that it's the SOEs which are driving the Chinese economy and the anti-competitiveness. I'm sure there's some some aspects of that in steel and so forth and so on, but my sense is that that's, in some sense, that's not the big deal, but I may be wrong about all that. I'm looking at Nick.
I mean, I think Nick will have good insights on that. I guess from our perspective, you're right in a macro level that I think private sector SOEs are only 15% of urban employment, and I think you can say that they're not so big, but they take the lion's share of credit. I'd also say that's where the opportunities are. That if you do projections of growth going forward, and you want to keep growth at decent levels, you're going to have to increase productivity. And if you do something sensible with SOEs, you can get quite big returns, whereas it's hard to see major improvements in other sectors of the economy. So I think that's a bit where we'd look at it, but maybe Nick could speak to that one.
Well, I think when we talk about subsidies, we have to be very careful, because I think when the Chinese say there are, I think you reported this was one of their pushbacks. No, there are no subsidies. My interpretation of that is that they don't have a systematic policy of subsidizing enterprises that are losing money. If you look at the universe of listed state-owned companies, 80% of them get subsidies. Many of them were profitable before they got their subsidy. Quite a few were not profitable pre-subsidy, but became profitable after subsidy. And then there's another big group that was money losing before subsidies, and even after they got their subsidies, they're still losing money. So most of the subsidies seem to be handed out for firms that engage in various things that the government is in favor of. So one of the favorite ones that Dushan, my research assistant, found is Dalian Wanda, their listed cinema company, which is highly profitable, got a fairly substantial state subsidy because they have done several things that are judged to be supportive of the government's policy of supporting the cinema industry. So there are lots of subsidies in the system. Now, you only get that kind of transparency for listed companies. You don't get it for the, and that's a very, very small slice of state companies, the ones that are listed. I can't remember exactly, but they're less than 5% of state companies are actually listed where you can get this fairly detailed information. So I think that's one of the problems about subsidies. There are a lot of subsidies. Firms get subsidies for engaging in activities that the government wants to support. And those subsidies go to private companies as well as to state companies, although if you look at the listed companies, state companies are getting more than their share, shall we say. So I think that's one of the communication problems. And in terms of international standards, maybe there are international standards, but this whole thing is very, very untransparent. So I think it's very difficult to judge. And one of my first offline emails to Jeff is going to be how he adjusted that profitability number in that very interesting diagram that he showed us.
Don't tell Secretary Mnuchin about the movie subsidy. Jacob Kierkegaard.
Kierkegaard from the Peterson Institute. I guess a question, maybe mostly for James, but also for Jeff. The Peterson Institute, some of your other IMF colleagues, and I believe one of the Korean research think tanks recently had a conference focused on secular stagnation in Asia. And the sort of one sentence description of, at least that I heard, of the main concern of many of the Asian policymakers there was fear about aging. And my question is now, okay, the Article 4 is a regular publication, so maybe such long-term considerations do not play. But how do the Chinese leadership think about this issue, given the outlook on that front that they're facing?
Yeah, thank you, Jacob. Actually, it's a valid criticism of our Article 4, so we probably haven't done enough really long-term analysis. We may need to do some more. The ones I've seen have been really quite sobering for China. One of the fastest aging societies, and the numbers look bad, and the estimates of the implicit debt in the pension system really make your eyes water. And I think the authorities are pretty aware of this. They are acting slowly to take the reforms of the pension system. They're thinking about moving the assets into the social security system and investing it better, but I don't think we're seeing the changes to the parameters that we might envisage in some of the industrial employee pension schemes that would think that they're well ahead of this. I don't know, they just, as I say, it's a constant theme when we talk about boosting consumption. They say, but we have this huge amount of consumption we'll have to do when our population becomes older. So I say they're very aware of it, and maybe we at the IMF need to focus a bit more. We're looking at it across the region now, and I think China will be part of that study too.
A couple points on this. I mean, I think one of the underlying problems is not just that the working age population is, peaked a couple of years ago and is going to be going down for the next 20 years, but they've never adjusted their retirement ages. The retirement ages were set in the early 1950s at 55 for women and 60 for men, when the average life expectancy was 50. And now their life expectancy is within a few years of most OECD-type countries, not quite as high as Japan's, and they haven't adjusted. But for the very first time this year, the authorities are publishing papers about raising the retirement. And besides that, a lot of people take early retirement. The average age of retirement is 54. So, they have a kind of, and they have a high replacement rate and all kinds of other things. I think they're going to raise the retirement age, probably slowly, but I think it's inevitable. Plus the kind of changes that James was talking about.
Yes, please.
Thank you. Katie Wang with NTD TV. My question is that we know President Trump, he has been emphasizing on fair and balanced trade, and China has been one of his targets to try to balance the trade relations. So I'm wondering if there's a trade war broke out between US and China, how will that impact the Chinese economic growth, and how vulnerable China's economy is to this? Thank you.
Well, we included a short section about this in the Article 4. So the exact impact on China depends on whether or not there are retaliatory tariffs in China and what happens with the exchange rate. And we include estimates based on the assumption of a 10% across the board tariff. And so obviously those are not highly precise. But I think our impression for now is that there is a desire to be measured on both sides, and that the chances of something that reaches a scale that is highly destabilizing for China is not in our base case. So we see it as a downside risk, but it's not something that is kind of one of the most likely risks that China will face.
Maybe I can just add the kind of perspective that we take at the IMF. We do not get into the micro level of the details of who says what about whom. What we'd say is a couple of things. For us, China would benefit from having more foreign involvement in its economy. It would help improve technology, efficiency, import governance from the West. And we know that trade produces a lot of benefits, and we think China could have even more if it were to open up more to the foreign sector. More generally, we look at trade through the prism of macroeconomic imbalances. So we think that the focus in China should be moving towards boosting consumption. And that, of course, would have the benefit of increasing imports from the rest of the world. And in the end, the amount a country imports is really a function of the difference between how much it saves and how much it spends. Trade policies may affect it at the margin and put it here or put it there, but overall, it's the big macro trends. And we think that China could do more by reducing its savings, which would help China's imports increase in general. So we have a bigger picture perspective than the kind of micro trade, although we still think that the multilateral system has served the global economy very well in recent years, and China especially, and we want to make it stronger and fix any problems that it may have.
Just one more point on that. I think that there's a lot of focus on the openness on the trade side, but at the same time, it feels like the world is going in the wrong direction on the capital account side. If you look at what's happening on FDI and ODI in China, so FDI is now declining in China. Overseas direct investment from China is also declining, both because foreign governments are being more resistant, but also because China is putting on capital controls. And so if you look at China's own targets for 2025 in manufacturing in the sectors that China wants to be dominant in, you have to ask, how is that going to happen if there is not technology transfer vis-a-vis direct investment? And you see with the EU's announcement most recently about having the equivalent of what is already existing on the national level to be more resistant or to be more careful about accepting Chinese investments, it seems like the world is starting to more mimic the regime on the capital account that's happening in China to be more protective on the senses of national security. So I think that while focusing on the issues on the trade side, I think it's also important to say, is what's happening on the capital account in China consistent with China's own goals over the next 10 years?
Yeah, I just wanted to come back. Markus Rodlauer from the IMF. I work with these two guys on China, on the question of state support for industries and growth and whether it matters statistically and otherwise. I think there's three. You have to separate three questions that are related but really different issues. The first one, and perhaps the smallest one, is the quantification of the explicit subsidies to the state-owned enterprises, which 3 or 4% of GDP is large, but is significant. Is not the real issue. It does matter, of course, hugely whether the government deficit is 3% or 12%. I think we all would agree, and there are standards. The key question here is not the state-owned enterprises. The question is what happens at the local government level, whether there's a state-mandated drive to invest, and whether these projects that are being invested in, I think the government would kind of agree that this is state. That's why they call them local government financing vehicles. But they now say this is no longer going to be government debt. It's all profitable. It's all investment. These are all projects. Even though just 2 years ago they recognized and they had a big jump in the debt. So whether the deficit is 12 matters macroeconomically, but it matters for the key question that Mark sort of raised. When is the game up? The game will be up when the government does not have the credit anymore to back up the financial system. And that matters whether the government debt is 40 or whether it's 90. We tend to believe that even at 90, they're still quite far away from the government not having the capacity to back it up, because the assets of the government are huge, and the capacity of the government to marshal these assets are huge. But I think that's a key question. The third question, which is broader and also very relevant, is what does it mean, state support? You have a subsidy to an SOE. You have this huge investment drive that's facilitated by the state. But you also now have a 100 billion Renminbi fund to develop the semiconductor sector, which means that private companies, really private, semi-private government companies, are now able to finance huge projects in that area in a way that they probably wouldn't be if it was truly market-based. And that is happening on a major scale everywhere in the economy. Probably that's how you somehow got this overcapacity issue. And even though when the government is saying they're reducing overcapacity, new lines are still being created by the same companies who are cutting lines that are inefficient but creating very new ones. So this massive state presence in the economy, in how land is allocated, how permits are being given, how credit is being financed, how the state financial sector stands behind them, that's a whole different kind of issue, which is what I think James mentioned is just a different, very orthogonal development strategy that they're having. And whether that's for China in the end successful or not, I don't think anybody can say, but I think it's a big issue, of course, for many other aspects.
Okay, we're approaching our witching hour. I think we have time for one last question. If nobody, Martin, I was going to call on you anyway, so you beat me to the punch. This is Martin Turzemba, who has recently joined the Institute from China, where he was living.
Yeah, thank you for this excellent discussion. I wanted to ask not about the overall debt levels, although I was very interested by the comment in the Article 4 that further financial deepening would potentially be a negative for the economy, which I think is probably quite rare for these things. But your assessment of the financial sector's capacity to shift a bit in the composition of the debt from some of these more implicitly or explicitly guaranteed SOE loans towards a more consumption loan type, and we're seeing all sorts of new financial institutions coming up, whether it's internet finance or consumption finance companies, and whether you think that this will be able to raise the efficiency of the financial sector and also contribute to the rebalancing aspects that you think are so important.
Yeah, it's we're in favor of financial deepening in many of the emerging markets, but China, by any metric, has gone beyond what you can think is a positive financial deepening, and now it's getting into the kind of the Kuznets curve of bad financial deepening, the kind of financial deepening that happened in Ireland in 2006, 2007. And interesting enough for the IMF, as I say, everything I've ever written in the IMF, I just kind of reverse the word do to do not and vice versa. Like, I used to say, liberalize your capital account. Now we're saying, hey guys, slow down on anything on capital account liberalization because your financial system isn't ready for it yet. And that's I think what you're talking about here. Within the composition of the financial system, one thing I've been positively surprised about, and I've said too many negative things actually in my remarks, very positively surprised about, as Nick was hinting, they've really got the message about the financial sector risks. And that's across the board. It's not just one agency doing one campaign for 3 months. It's all agencies from the top, a concerted and coordinated campaign. And I think this is a real positive feature. If they can build on this, we could be in a very good place. In terms of the structure of credit, it's true that the structure of credit has changed. There's less credit maybe marginally going to SOEs. But I'm not sure household mortgages is the answer either. And that's really what's been driving it. The housing market's been driving the boom over the last 12 months. And I think we all know that just building a house of cards on houses is not the answer either. So I don't think we've seen the change in the credit culture and the lending culture of the banking system as a whole yet, which will make us think we're not going to see further excesses.
Yeah, but you do see that change happening. So, I mean, the balance sheet of households are not that stretched, including on mortgages, and non-mortgage credit does not exist in scale. And you do see the banks, as the concern is going up at the margin about the corporate sector and with the supervisory tightening, shifting more to the household. And at these levels of loan-to-value ratios, things don't look that alarming. Mortgages in percent of GDP are still relatively low by any international comparison. The problem is just that the price increase that's been going on is unsustainable. So as leverage rises, you're going to have an increasing risk of a reversal there.
So I think we can all agree this has been a very interesting discussion of very serious issues, not only for the Chinese economy, but how the Chinese economy interacts with the rest of the world, which, given its size and centrality, is important for all of us. Please join me in thanking our three speakers, Jeff Gottlieb, James Daniel, and Nick Lardy. And I will declare this meeting adjourned. Thank you.